SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to the SUERF-Baffi Bocconi e-lecture on navigating economic shifts, the AI boom, public debt and financial market risks, lessons from the 2026 BIS Annual Economic Report. The 2026 BIS Annual Economic Report was released a few days ago. Today's e-lecture brings together its leading authors to present key messages of chapters 1 and 2. Let me first extend a big thank you to Fiorella de Fiore, Research Advisor at the Monetary and Economics Department of the BIS and member of SUERF's Council of Management, for initiating and co-organizing this e-lecture. Fiorella will also lead us through the event. Let me also give a warm welcome to our speakers. Frank Smets will present Chapter 1 of the BIS report entitled The AI Boom and Risks to the Outlook. Frank is acting head of the Monetary and Economic Department and head of Economic Analysis and Statistics at the BIS. Frank is also a long-standing and esteemed SUERF Fellow. Frank's presentation will be discussed by Dabla-Norris, Deputy Director of the Fiscal Affairs Department at the IMF, who has recently also worked extensively on AI. Chapter 2 on rising public debt and financial market fragilities will be presented by Gaston Gelos, Deputy Head of the Monetary and Economics Department and Head of Financial Stability Policy at the BIS. Gaston's presentation will be discussed by Filiz Unsal, Deputy Director of the Policy and Research Branch in the Economics Department of the OECD. We are also proud to count Filiz among SUERF's fellows. We will devote 45 minutes roughly to each of the two chapters. We will start with 20 minutes of presentation, then have 10 minutes of comments by the discussant, and conclude each part with reactions by the presenter and Q&A with all participants. With this, let me hand over to Fiorella, who will guide us through the event.
Thanks a lot, Ernest and Dragana, for the organization of this event. It's really a pleasure for me to introduce this lecture and to moderate the discussion with such distinguished speakers. Navigating economic shifts, the title of today's lecture, is especially important for central banks in the current context, as they try to maintain macrofinancial stabilities amid the rising inflation, geopolitical tensions, and technological changes. Looking at the past year, the global economy has shown resilience despite tariffs, geopolitical uncertainty. However, the disruptions that came from the war in the Middle East have driven inflation above central bank targets and are also threatening growth prospects. And in addition, governments are also facing rising spending demands and high interest burdens with limited fiscal space. Today's agenda addresses some of these challenges based on the BIS Annual Economic Report. The first presentation will explore the risks to the global outlook and the promises of artificial intelligence, while the second will focus on pressures that arise from rising government spending and high interest costs among growing financial vulnerabilities. Without delay, let me give the floor to Frank for the first presentation.
Thank you very much, Fiorella. Basically, in Chapter 1 of this year's BIS Annual Economic Report, we reviewed the past year through two lenses, what we call progress and peril. Progress from rapid advances in artificial intelligence and their potential to boost economic activity, and peril from heightened inflationary pressures, financial vulnerabilities, including those related to AI exuberance and high public debt, all of which weigh on the outlook. And so in my presentation, I will go through some of the elements of progress and peril. If I can have the next slide. So this slide basically shows the evolution of expected, basically consensus GDP growth forecast over the next year, over the past year. You have two vertical lines. Line A basically corresponds to so-called Liberation Day, the announcement of significant tariffs by the US administration. And line B responds to the start of the conflict in the Middle East, the Iran war. And so you see how following Liberation Day, expected growth fell quite dramatically in a number of countries, but then forecasts were revised upward again throughout the year until the conflict started and there was a new downward adjustment in the growth forecast. When you look at the right panel, you see how these three phases look like in individual countries. And it's not surprising that when you look at the red bars, which is the downward forecast revision of growth following the Liberation Day, some of the countries and jurisdictions most affected are the US and its trade partners like Canada and Mexico. The blue bars are then how this downward forecast was revised during the year. And then the yellow boxes are the downward revision following the start of the conflict in the Middle East. And obviously you do see in again focusing on the right-hand panel that downward focus, at first it was smaller than the expected impact for many countries of the tariff increase. And secondly, the distribution was a little bit different. The conflict in the Middle East with its impact on energy prices and the closure of, because of the closure of the Strait of Hormuz, affected there relatively more the euro area and countries like India that were more dependent on energy. So let me go through two of the main reasons why the global economy proved to be more resilient than we thought initially last year. If I can have next slide. The first one is that the impact from tariffs was milder than feared. And here you can see that in the reasons in a number of panels. First, on the left-hand panel, the first reason is that actual effective tariff rates were much lower than what was feared in the beginning, which was tariff rate of above 25%. In practice, if we look at the most recent estimates of effective rates, we have something more close to 7%. And the middle panel shows you how the initial estimated impact of the tariffs in the US, global economy, China, EU, and Asian is reduced because of this revision from lower tariffs. That's the orange part. So that a second reason is that actually the global trading system adjusted and trade flows were rerouted, diverted to deal with the differential tariffs across the world. And so that's the blue part. So as a result, what the middle panel shows is, for example, for the US, is that because of this lower than expected effective tariff rate and the trade diversion, the estimated impact halved from something that was closer to -1% to something that's closer to -0.5%. And a third reason that we highlight in the report is that those industries that were most affected by tariffs did absorb some of those increases in costs into their margins. And that's what you see on the right-hand side. So the two first panels show you that there was a reduction in margins in those sectors and countries, firms that had faced high tariffs. So that's one set of factors, basically the adjustment in the global trading regime that led to a lower impact and a more robust global economy. The second, and to some extent that is one of the focal points also in the chapter, the second reason is the optimism surrounding AI, which provided a lift through both real and financial channels. If I can have next slide. Basically here on the left-hand side, you see the increase. So that the real channels is basically to a large extent through investment and the building out of the capacity of the AI ecosystem. You see here on the left-hand side the capex that grew quite significantly and reaches almost 1 trillion this year by US hyperscales and other AI firms. This led to a strong increase in investment growth, particularly in the US, as you can see in the middle panel, that's the red line, which reached above 3%, and had these ripple effects across the global trading system, in the sense that demand for materials and inputs in this build out of capacity, AI capacity, led to increasing exports, particularly from Asian countries. That's the blue dashed line in the middle panel. So that's kind of the real channel through which AI provided a countervailing factor and a boost to global economic activity. There's also a financial channel, which we illustrate on the right-hand panel, that equity markets were boosted and boomed through most of the year. And this led to a big increase in equity wealth to income, which is the blue line you see on the right-hand side, with, of course, positive impacts on consumption, first and foremost in the US, but more generally, as there has been quite a bit of foreign investment in the US stock market. And more generally, it led to easy global financial conditions, as you can see on the red line. Basically, global financial conditions here measured using the Goldman Sachs index basically eased after initial increase throughout most of the year. Now, against this background, then came the sort of the second shock, which is the conflict in the Middle East, which led to the closure of the Strait of Hormuz traffic, as you can see on the left-hand side, and a big increase in oil prices. The middle panel basically shows that in terms of the share of oil supply that was cut, this is probably the biggest shock if you compare it to previous episodes of oil supply shocks, like the oil embargo in '73 or the Iran revolution event in '79. Having said that, if you look at the price changes, the prices actually increased by relatively less than in those episodes. And one of the important elements there has to do with the use of oil reserves and the release of global reserves. In the report, we do an econometric analysis to look at what the possible effects of a closure of the Strait of Hormuz could be. And you can see on the right-hand side that it did, that we estimate to lead to global stagflationary effects. So a fall in global industrial production and a rise in global CPI. Next slide, please. At the same time, we find, again, like in the early episode, that the financial conditions remained very easy and exuberant after initial tightening. So you can see that on the left-hand side, when we talk about equity valuations, there was a small dip after the start of the conflict, but then equity valuations went back to their previous stretched levels. And you see the same when you look at credit spreads, the middle panel, or the dollar, for that matter, which swung with risk appetite. So that's basically the story of the year. And then in the report, if I can have the next slide, we then talk about how, sort of, to what extent is this surprising resilience of the global economy in the face of these relatively big supply shocks. To what extent is this resilience robust, or can it, or is it fragile? Can it last? And we look at 4 pressure points. First of all, the return of inflation and what that means for monetary policy, interest rates, financial conditions. Secondly, the sustainability of the AI boom. Thirdly, the persistence of existing financial vulnerabilities. And finally, the strained fiscal balances. And on this, Gaston will say more when he talks about chapter 2. So let me first talk about inflation. I mean, clearly there was an immediate response of headline inflation to the rise in energy prices, as you can see on the left-hand side with the yellow. Now, of course, inflation did respond. You saw the increase in energy prices. That's the orange. And then the red one is the rise in global inflation. Now, when thinking through how to respond, obviously, by central banks with monetary policy to this increase in inflation, there's the traditional questions to be asked: how transitory will this shock be? To what extent will it feed into core inflation? Will it have second-round effects? That will depend, obviously, on the duration of the conflict itself and the rise in energy prices. And of course, their initial reactions pointed to the fact that the conflict was estimated to be of relatively short duration. And of course, recently with the developments around the peace plan, we have seen that oil prices have fallen back quite a bit. But these initial increases in energy prices have already led to quite big increases in some of the intermediate inputs like plastics and fertilizers that rely a lot on gas and oil inputs. And of course, the structure of the economy will explain or will depend on will determine how much of a pass-through one gets. And what you have on the right-hand side is basically an estimate using country-specific input-output tables of the direct and indirect effects of the oil price shocks on a number of countries. Obviously, the structure of the economy will very much depend how large these are, with, in this list, Malaysia having being most affected, and to some extent US being least affected. A third factor, so there's the duration of the energy price shock, there is the economic structure and how energy price shocks feed through into the input-output and the supply chain in the country. The third set of factors is initial conditions. If I can have next slide. And in the report, we kind of report some econometric analysis on how the pass-through of a 10% oil price shock feeds into inflation depending on initial conditions. And there we see that, first of all, where inflation and inflation expectations are will matter. If you are in a jurisdiction where inflation is above the target or inflation expectations are above the target, then the pass-through will be almost, well, triple the pass-through if you are below target, as you can see on the left-hand side. If you're in an economy where the labor market is tight, again, the pass-through through second round effects will be almost double that if you are in an economy with a loose labor market. And then also fiscal policy stance will be important. In a country with a loose fiscal policy stance, the pass-through will be larger. If we sort of translate it, obviously countries are in very different situations, and that also explains some of the differences we've seen in policy reactions. But overall, sort of from a global perspective, if you compare it with the previous inflation surge, the post-pandemic inflation surge, probably in terms of labor markets are a bit less tight than they were then. In terms of fiscal balance, fiscal policy has been so far less responsive than it has been. The question mark we raise in the report is about inflation expectations, to the extent that households in particular still remember the big inflation surge. This may be a factor that leads to higher pass-through. Then the second part is about AI and the sustainability of AI. Let me skip this slide and go to the next one to just show that we do a bit of historical analysis to show that these big innovation waves often have led to big build-in capacity. I mean, here you have the building of the canals, the railways in the 19th century, often led to then a bust in investment later on. And so that's one of the risks and the vulnerabilities that we discuss in the report. This goes together, if I have the next slide, with financial market exuberance that is there. Equity markets are stressed. Risk compensation has clearly fallen in US equity markets after the pandemic. And as I mentioned before, income, wealth, the share of equity markets in total wealth has increased across the different deciles of the income distribution. I can have the next slide. Together, so we are in a situation where the boom could run into constraints, where if that has an impact on equity markets, this may have wealth effects on consumption. And thirdly, as the boom has become more and more leveraged, so increasing share of the investment is financed by debt, also some of the propagation through this leveraged positions may increase. Let me skip the next slide and then go to the last sort of pressure point that we highlight, which is the fiscal positions, which are under increasing strain. Fiscal positions have deteriorated. We see an increasing ratio that is spent on interest payments and interest burden, as you can see in the middle panel. In a number of high debt countries, particularly also in advanced economies, which is somewhat new, the interest rate payments are sort of the largest share of expenditures by governments at this point. And of course, with the rise in interest rates and the kind of lower growth in a number of countries, also the interest rate growth differential has increased a lot. Finally, not something that is not shown on here is that in a number of countries, including the US, there has been much more short-term financing, which makes debt also more the debt burden also more sensitive to interest rate changes. So what we argue in the report is that each of those 4 pressure points may seem manageable, but it's really the interaction that make the situation, the global financial stability situation, fragile. If I can have the next slide, and then the next one. So we go through a number of policy challenges that this faces for monetary policy, fiscal and structural policy, and regulatory policy, but I suggest we come back to that after Gaston's presentation of chapter 2, because there's some overlap there. But let me stop here.
Thank you, Frank. So we can then move to the discussant, Era Dabla-Norris from the IMF. We cannot hear you, Era, you're muted.
Dragan, if you could pull up the slides, that would be great. Just wait for it. Okay, so let me just start by thanking Frank and the authors for a very insightful and timely chapter. The report really offers a very compelling account of how the global economy has managed to navigate a large sequence of significant shocks. But it also highlights a very important tension between resilience on the one hand and growing vulnerabilities on the other. So next slide, please. So I would call this, a year that really took place in 2 phases. And the report documents very surprising resilience despite major shocks, something that we've also touched upon in our World Economic Outlook and our Fiscal Monitor. We've had the largest tariff increases seen in decades, but at the same time, growth is held up, and it's held up because of trade reallocation, very strong investment in AI, and accommodative financial conditions. This changed sharply, as we all know, with the disruption to the Straits of Hormuz, which cut more than 10 million barrels of oil supply per day, about 13% of global oil supply. And notwithstanding this, the overall picture is much more favorable than one would have thought. But underneath all of this, vulnerabilities have increased, including risks of persistent inflation, financial fragilities, and constrained fiscal space. So on the whole, one could argue that the global economy is operating in a more fragile equilibrium where resilience is actually coexisting with rising risks. Next slide, please. So against this backdrop, AI emerges as a central through line in the report. It helps explain both the resilience that we've observed over the course of the last 2 years and some of the risks that are now building up. And what's important to note, and something that the report highlights, is that AI is in some sense already macro-critical, but it's primarily through investment, financial conditions, and expectations ahead of any measured productivity gains. So in my discussion, I'm going to zoom in on the AI component of the report because much has been said about the other aspects. And I'm going to structure my discussion around 4 areas that are touched upon in the chapter. The first is the composition of today's resilience. The second is the growth dividend coming from AI and as a distribution of outcomes. The third is labor market and distributional effects that the report briefly touches upon. And finally, I'm going to end with a discussion of fiscal and financial vulnerabilities. So next slide, please. So as the report highlights, AI-related investment has already contributed meaningfully to growth. In the United States, for instance, AI CapEx is estimated to have contributed about 1 percentage point to GDP growth in 2025. And this growth is operating not only through direct investment, but also through financial channels, with rising equity valuations supporting demand through wealth effects. And these dynamics are in turn reinforced by global spillovers, particularly through demand for semiconductor, digital infrastructure in Asia, and also rising equity valuations are explained by foreign investments in equity. However, there is still very limited evidence that these developments reflect a broad-based shift in the supply side of the economy. And this leads to my first question. How much of the resilience that we see today reflects cyclical demand as compared to financial conditions rather than a durable structural shift of the economy? My second point has to do with productivity and uncertainty. And in a sense, there's a striking gap between what we see at the task level, the really large productivity gains when you sort of decompose what tasks individual workers are doing within occupation, smaller aggregate of GDP growth. And as noted in the report, task levels efficiency estimates are about 20 to 50%, while aggregate productivity gains are estimated less than 1%. And so the report appropriately frames the future, given the kind of massive uncertainties that we see, as a range of scenarios, from bounded gains to transformative growth, or even a demand bottleneck where you can have weak links in the chain or other types of bottlenecks that stymie the massive productivity benefits of AI from materializing. These have very materially different implications for how we think of as R star. Now, the key issue here is one of timing. How quickly is this massive investment, massive capex by hyperscalers translating into measurable productivity or economy-wide productivity gains? And this raises my second question, which is, what determines really this lag between AI investment and aggregate productivity? And how should policy in particular think about that lag? How should policy think about that lag? And this timing is really central for how we think about growth expectations, not just in 2026, but going forward, and policy calibration. The next slide, please. So when we think about the labor market effects, I mean, the report presents some early evidence of labor market adjustment in AI-exposed sectors. So these are primarily the computer-intensive sectors or code-intensive sectors. And in particular, the report highlights that in the US, sectors with higher exposure to AI have experienced, on the one hand, higher productivity growth, but at the same time, lower employment growth relative, and I think that's important, relative to other sectors. But at the same time, firms, particularly larger firms, are increasingly signaling intent to automate tasks, although we're not seeing any real signs of large-scale labor market displacement. However, fundamentally, this challenge is that the evidence remains correlational. This is really correlations. And it's very difficult to establish causality that the AI build out is having a material benefit on the labor markets. And this leaves really a lot of uncertainty about how AI will actually affect labor market and aggregate demand. And this brings me to my third question, which I think is an important one for us to ask, which is, to what extent can this observed labor market patterns, primarily in high AI exposure sectors, be actually attributed to AI rather than, say, to other broader structural changes that are taking place in the economy. Next slide, please. So when you look at financial sort of vulnerabilities that are sort of bubbling, not just beneath the surface, they're quite apparent. Financial markets appear to be strongly pricing in expectations of AI-driven growth. And this is reflected, as the report highlights, in a number of ways. Firstly, elevated equity valuations, particularly in AI-related firms. Secondly, we're seeing risk premia that are very, very compressed, even by historical standards, and despite everything else that we're seeing, all the other geopolitical risks that we are seeing. And this indicates very strong investor optimism. And we're also seeing this surge in debt-financed investment that I also spoke of earlier. In fact, as the report highlights, the 5 largest hyperscalers are expected to spend over $1 trillion of AI-related capital spending between 2025 and 2026. And in some cases, this is outpacing earnings and free cash flow. And the trajectory going forward is even higher. At the same time, we see that the financing structures are becoming much more complex, including having these types of circular financing arrangements, which link hyperscalers, AI labs, and suppliers. And the important point here is that given that US equities account for roughly 64% of global market capitalization, any repricing of AI-related assets could have significant global spillovers. And so this is not just a wealth effect story for the US, but it could have material implications for the global economy. Next slide, please. The report talks about the lack of fiscal space, but there's a point that I wanted to highlight here, which is that these uncertainties about the financial vulnerabilities, and I didn't even mention mythos and cyber risks, sort of old challenge that financial regulators and supervisors have to face, but in a more elevated guise. So there's all these uncertainties about the real effects or the productivity effects of AI, the labor market impacts, the financial vulnerability piece, and all these uncertainties interact with already constrained fiscal positions that we see in many countries. Public debt remains elevated. In the fiscal monitor, we noted that global public debt is expected to exceed about 100% of global GDP by 2030. And as the report highlights, cyclically adjusted primary deficits in advanced economies have averaged about 1.9% of GDP since 2022, and this is nearly double the average of the previous 2 decades. At the same time, we see that rising interest costs are putting pressure on fiscal space. Interest rate growth differentials have become less favorable. In many countries, spending demands have increased, whether it is to pay for population aging or defense, or just to meet development needs. Now, what AI introduces is both an upside potential through stronger growth, stronger revenue bases. At the same time, at least in the short term, at the same time introduces downside risks through financial stability, weaker growth, possibly more significant labor market disruptions, where the governments will be left holding the bag. So the same uncertainty has very different implications depending upon the initial fiscal conditions that countries face. And countries with more limited fiscal space are much more exposed to adverse outcomes with less ability to cope with the ill effects of the fallout. Next slide, please. So to conclude, the chapter's central message is really one of progress and peril. But the structural productivity gains and the effects of AI, in a sense, the real effects or the cyclical effects are already visible. But the structural productivity gains are still very uncertain, both in timing and in magnitude. And this creates fundamentally a sequencing problem that is central to the report. The benefits are expected, while the risks, in some sense, are already materializing, are already apparent. And this has direct implications for policy. And what I wanted to highlight here is that policy should not treat the AI dividend as realized, but as uncertain and potentially even state contingent. And managing that tension between realized resilience and uncertain structural gains is really going to be the key policy challenge going forward. So let me stop here. Thank you.
Thank you very much. Frank, do you want to react to the discussion first before we take some questions? Cannot hear you.
Yes, well, first of all, thank you very much, Ira. This is a splendid discussion, and you touched on many of the very important issues. I think your first question, how much of the resilience is due to demand rather than supply? I think you've answered it yourself, and I think we would agree. We do see some evidence of beginning productivity effects in the sense that those sectors that are more sensitive to the use of AI seem to have some productivity benefits relative to others, but yeah, it's difficult to be very firm, and it's really only the beginning. And so what we see so far is mostly demand driven, which of course also has implications for inflation and for monetary policy. Your second question, what determines the lag from AI investment to measured productivity? I mean, there it's interesting to make the comparison also with previous, like the IT boom, where we saw actually a quite long lag between the effects within the industry itself, which are relatively direct, but then a very long lag with the adoption of IT into other sectors. And one interesting question is whether actually the use of AI itself may actually increase that adoption or not. I mean, some of the factors that are key here is, and again, these are lessons also learned from the IT boom, where you have the organizational capital to reorganize your firm. Finance will be important. I mean, some of the surveys, for example, in Italy, where they ask, so why haven't you actually changed your finance? Is one, you need financial resources to invest in the adoption of AI and change your production structure and to benefit from the. And then more at the economy level, of course, there's also the general issue of goods and labor market flexibility. And that's where one area where I think we call also for structural reforms in those economies, particularly that are not as flexible. I think that will be very, very important. Let me then just say one question on, or the fourth question, what is the most likely trigger for a repricing? I mean, of course, that's very difficult to say, but we're pointing to those four pressure points. I mean, one is interest rates, monetary policy. That's why kind of inflation and where that is going is important, because higher interest rates may have implications for credit risk, for financing costs, for debt sustainability, and so you may get some propagation there. And the other thing is, of course, what's going on in the AI sector itself. Now expected earnings are very high, and so we have to see to what extent these actually are delivered. But thank you very much.
Thank you both of you. We just have maybe a couple of minutes, and we have many questions. So let me maybe pick. There are a couple that are a bit more on conjunctural side, asking how sustainable can U.S. firms' margin compression be, and whether this can lead to counter movement boosting inflation. And on the other side, also on the side of oil prices, the fact that reserves are running really low and production capacity cannot be boosted in the short run. How can, what would you expect oil prices to be, and therefore also the inflationary pressures from that? Maybe, do you want to say something?
I can briefly respond, and then maybe you can get the questions at the end after Gaston's presentation. But I mean, on the margin squeeze, I think again depends on which sector, which company you talk about. But clearly there was an increase in profit margins before. So to the extent that profits were relatively, abundant is not the word, but profit margins were relatively high, there is some room for squeezing of those profit margins. And on the question of the reserves, well, okay, that is one element that we also mentioned in our report as a factor that may keep, at least in the short term, oil prices, everything else equal, a bit higher as countries build up their reserves, and this increases, keeps the demand for oil and gas, for that matter, a bit higher. It's not very much what we see in the future prices. They're a bit higher than pre-conflict, but then there's so much volatility that it's hard to say.
So I would say let's make sure we don't take time from the second presentation, and maybe we can pick some of these questions at the end in the next Q&A session. So the next presenter is Gaston, and he will be talking about the rising public debt and the financial market fragility.
Thank you. Can you see my presentation full screen?
No, not full screen.
Now?
It? No. Yes. Perfect.
Okay. Very good. All right. So the second chapter is about the high public debt that Frank was already talking about, but how that combines with changes in financial markets to create new fiscal financial fragilities and the central bank challenges that are associated with that. Okay. So as we discussed, public debt in many economies has climbed to levels close to the peaks reached after the World War, and is set to remain high because, as Era mentioned, there are still spending pressures, structural spending pressures from aging, investment needs to improve infrastructure for defense and so forth. At the same time, the structure of sovereign bond markets has shifted in important ways, and in particular, leveraged non-bank financial institutions, specifically hedge funds, now play a larger role in intermediation, and they rely on short-term funding and are very connected to banks and other NBFIs. And these developments have created a new fiscal financial stability nexus in which stress can propagate quickly through funding markets across borders and between banks and non-banks. As a result, government bond market liquidity can appear ample for long stretches, but evaporate quickly when shocks hit, raising borrowing costs and compressing fiscal space well before fundamentals alone would suggest. So against this backdrop, central banks face three interrelated challenges. First, when investors reassess fiscal sustainability or liquidity, sovereign yields can move more sharply and more frequently, tightening financial conditions quickly while having perhaps less certain effects on inflation. Second, high public debt makes monetary transmission more complex by altering the balance among valuation effects, interest income transfers to bondholders, and the potential repricing of fiscal risk. And third, market dysfunction may require more frequent interventions, but at the same time, repeated interventions risk encouraging more leverage and worsening the problem, weakening market discipline, and blurring the monetary policy stance. So here you see that government debt to GDP ratios for both emerging markets and advanced economies are projected to remain elevated. They're supposed to come down a little bit, but fundamentally they are going to stay high, absent any significant adjustment. And the rise reflects the succession of large shocks over the last 2 decades and the policy response to them, from the great financial crisis to the pandemic and recent geopolitical tensions. And as mentioned, fiscal pressures are unlikely to abate. Demands for public investments, demographics, defense, energy transition are all factors that will demand further fiscal expenditure. And this happens in an environment where financial conditions for borrowing or the overall environment is more complicated. Sovereign yields have risen, so real rates are higher. Growth has slowed from post-pandemic peaks. And this means that the interest rate growth differential has narrowed, and increased interest payments as a share of GDP now pose a challenge in many economies and are one of the largest expenditure items. So, so if there are no offsetting measures on revenues or other spending, or if growth, perhaps due to AI, really takes off, this will mean that fiscal space remains tight, and that will also likely raise the sensitivity of public finances to shifts in market sentiment. And so why have we gotten here? Well, for a long time, fiscal policy in many countries has been asymmetric. Governments have tended to ease aggressively in downturns, but have not rebuilt sufficient buffers when times were good. That tendency seems to have worsened since 2000, with the governments appearing to have become even less responsive to rising public debt levels. So this chart documents how fiscal policy has adjusted too little in expansions, allowing debt to drift up over time. So this is based on econometric analysis. And overall, while primary balances tended to improve when debt rose in the 80s and in the 90s, that debt responsiveness has largely vanished in recent decades. So, for example, for advanced economies, you see that the range includes zero, so it's not very different from zero anymore. In other words, the primary balance no longer strengthens as much when debt climbs, even after controlling for the business cycle. And the cyclical pattern of fiscal policy has also been asymmetric. I alluded to this earlier. Fiscal tightening in good times has been much less forceful than easing in bad times, particularly in advanced economies. So when output was below potential, fiscal policy has tended to move countercyclically, supporting activity. However, when output was above potential, discretionary fiscal policy often remained pro-cyclical, and with the cyclically adjusted primary balance deteriorating instead of rebuilding buffers. That these behaviors both help explain why debt has remained high even over the longer term. So compounding the challenges posed by higher debt, the markets that absorb these larger volumes of debt issuance look very different now from 2 decades ago. Intermediation has increasingly moved beyond banks to non-banks. At the same time, official sector holdings have declined as central banks reduced their balance sheets and foreign official purchases moderated, increasing the supply that private investors must absorb. So in most countries, pension funds and insurers continue to provide steady long-term demand for government debt, but highly leveraged hedge funds now play a much bigger role in intermediating government bonds. And as these graphs show, hedge funds' sovereign exposures have risen substantially. Measured relative to GDP, US sovereign debt exposures of hedge funds in the US have more than doubled since 2022. And that has to do with an expansion of so-called relative value strategies that these funds have been pursuing, where they exploit small pricing differences between bonds and derivatives on these bonds. This is, however, not only a US phenomenon. We see similar developments in Canada and the UK. We see a larger importance of hedge funds also in Europe. In the euro area, hedge funds' share of electronic trading in government bonds has risen considerably. And you can see that here on this picture, for example. Now, funding terms for these hedge funds to finance these relative value trades have been unusually lax, with a large share of bilateral repos extended at zero haircuts, especially for the largest funds. Why is that important? Well, such terms allow very high leverage, but leave positions very sensitive to shifts in margins, haircuts, or derivatives pricing. So they make them much more fragile. And these charts capture the combination of changing holders, rising hedge fund exposures, and a broader trading footprint, underscoring why liquidity can dry up quickly when risk capacity tightens and why market functioning has become more vulnerable to shocks. So you have these hedge funds that are borrowing, they incur large leverage. They buy, for example, the treasury bonds, sell the futures to long-term investors, and then make a profit with the margin. But of course, that's very susceptible to changes in market conditions. And these two charts here show that although banks' direct sovereign exposures remain important, the traditional bank sovereign nexus has evolved. So yes, bank sovereign bond holdings are still high, but the sensitivity of banks' sovereign CDS co-movements has declined. What does it mean? So the reforms since the global or the great financial crisis have strengthened banks' capital and liquidity. So the co-movement between bank and sovereign risk is now less sensitive to banks' direct holdings of sovereign bonds, less than a decade ago, as seen on the chart on the left. In contrast, the nexus has broadened through indirect channels, banks' links to NBFIs, that is, non-bank financial institutions, including hedge funds, via repo financing, prime brokerage, derivatives intermediation, and funding from money market and other funds. These have become more important in transmitting shocks. So the right-hand graph shows the co-movement of bank sovereign CDS, which has become more sensitive to banks' exposures to NBFIs. So this evidence points to a more complex and potentially faster-moving nexus in which sovereign stress can reach banks through their services to leverage non-banks, and NBFI deleveraging can in turn amplify yield moves and tighten broader financial conditions. Risk to fiscal sustainability can have important financial market and real effects. When markets reprice fiscal risk, sovereign yields typically rise and currencies tend to depreciate, typically tightening domestic financial conditions. Because government yields are the benchmark for which many private borrowing costs, this repricing raises funding costs for households and firms, and also can trigger capital outflows. And the charts on this slide here trace these dynamics. Higher government bond yields on the left-hand side, and a weaker nominal effective exchange rate, NER, on the right-hand side, in response to higher fiscal risk. The effects on inflation and activity, they change over time. So you see here in blue, you see the effect on inflation and on industrial production, and in red on inflation. In the near term, weaker currencies and higher expected inflation compensation can lift consumer price inflation as imported prices rise and expectations adjust. Over the medium term, however, tighter financial conditions weigh on aggregate demand, and disinflationary forces dominate as real activity slows. So the credibility of monetary policy here is key to the strength of both of these channels. Strong credibility limits the extent to which fiscal stress translates into higher expected inflation. And by reducing the inflation risk compensation investors' demand to hold longer-term assets, it also moderates the tightening of financial conditions. Empirically, we can indeed see that these effects tend to be more pronounced when the central bank responds passively, that is, when it allows the real policy to turn negative after the shock, compared with the situations in which the central bank responds actively to inflationary pressures. This suggests that accommodation does not necessarily shield the economy from the adverse consequences of fiscal risk repricing, but could actually amplify them. A critical dimension of the new fiscal financial stability nexus, as we call it, is the interactions between fiscal risks, sovereign bond market functioning, and intermediaries' balance sheet. So take a negative shock that leads markets to reassess the fiscal sustainability. And so when markets are illiquid, when intermediaries' balance sheets capacity is constrained, the impact on yields will be higher than otherwise. And at the same time, the initial shock will tighten margins and compress intermediaries' risk-bearing capacity, prompting deleveraging, which will further impair market functioning. And so we find this type of interaction empirically. The absolute magnitude of fiscal surprises, adverse fiscal shocks, is larger in illiquid markets. You can see that on the left. And adverse fiscal surprises in turn erode market liquidity. You can see that on the right-hand graph. So against this backdrop, higher public debt and a larger role of non-bank financial institutions raise the likelihood of severe market dysfunction. So in this graph, we showed that the estimated probability of experiencing a stress event like the GFC within the next 3 months is about 10 times higher when the ratio of public debt to GDP is at its highest decile than when it is at its lowest decile. The probability of such an event also rises considerably when the share of NBFIs in government bond holding is very high. High public debt also changes how monetary policy transmits to the economy. And here there are at least three channels that matter. First, rate hikes can worsen fiscal outlooks by raising interest rate costs, prompting markets to widen risk premia, and amplifying the tightening financial conditions. But second, valuation effects from higher yields impose mark-to-market losses on holders of longer duration public debt, reducing the risk-bearing capacity and credit supply. And third, higher rates increase government interest payments, transferring income to bondholders. So that, in principle, can support demand and dampen disinflation. Evidence from European data shown in this slide indicates that when public debt is high, the disinflationary effects of monetary tightening is weaker, while the output contraction can be larger. Another interesting effect has also to do with the maturity structure of public debt, but I don't have much time to discuss it here. We discuss it in detail in the report. Let me conclude with policy priorities and key messages. So the policy message from all this evidence we have is in the chapter is that credible monetary, fiscal, and regulatory frameworks must work together to manage this new fiscal financial nexus. Monetary policy will need to navigate a narrower path. Too little tightening risks de-anchoring inflation expectations, while too much tightening risks outsized market reactions, given the leverage and intermediation that we have. And here, central bank is essential, but it is most effective when it is supported by credible fiscal sustainability and a resilient financial system. So on the fiscal side, the priority is to place public finances on a credible and sustainable path by restoring symmetry to fiscal policies. That means it's important to rebuild buffers during expansions within well-specified medium-term frameworks, enforce rules and effective fiscal councils. And the composition of consolidation matters. You don't want to cut indiscriminately and hurt growth. You want to cut where it hurts growth the least and protect growth-enhancing investment, and pairing it with structural reforms that expand the tax base and reduce debt ratios over time. In the financial regulatory area, policy should move toward what we call congruent regulation, so that similar risks are tackled with similar stringencies, no matter where they occur in the system. And here we discuss a number of proposals, including leverage limits, limiting liquidity mismatches, and others. And importantly, they cannot only be targeted at banks. We cannot just tighten NBFI rules and loosen regulation for banks, because that would not help contain the problem. Central bank liquidity backstops remain a powerful tool to address market dysfunctions, but must be carefully calibrated. They need to be targeted, temporary, and easily reversible. An example of that is the Bank of England's response to the 2022 liquidity-driven investment crisis. Expanding counterparty access to NBFIs could be helpful, but is also something that requires robust regulation. So, bottom line is that acting early across all those domains together reduces the likelihood that future shocks will force difficult choices between price stability, financial stability, and fiscal stability. Thank you.
Thank you, Gaston. The discussant is Filiz Unsal from the OECD.
Let me stop here.
Thank you so much. It's a real pleasure to discuss this year's BIS Annual Report chapter on high public debt and financial intermediation. I should say that the report makes a very important conceptual contribution by showing that high public debt can no longer be analyzed separately from the structure of the financial markets. As sovereign debt markets have become increasingly intermediated by non-bank financial institutions, financial stability and monetary policy and fiscal sustainability have become much more tightly intertwined. I find the report very compelling, and so, but there are a few areas that I would like to go in a little bit more and perhaps to go for some perspectives on this link between high public debt and financial intermediation. Next slide, please. So, of course, Gaston did an excellent job, but just to summarize what the report is mentioning and some of the main ideas in there. Traditionally, we thought of fiscal sustainability largely through debt dynamics and fiscal policy. The report argues that this may no longer be sufficient, and the growing role of non-bank financial institutions means that financial shocks are transmitted through market liquidity, leverage, and dealer balance sheets. As a result, sovereign markets become a source of macro-financial instability, which has profound implications for monetary policy, because ultimately central banks increasingly will need to think about not only inflation, but also preserving market functioning. I think that's a very important contribution. Next slide, please. So the report presents a new fiscal financial framework. I would like to challenge that a little bit and to say that to me, it's more of a new macro fiscal financial framework. As Gaston mentioned earlier in the report, of course, some of these high debt levels are also a reflection of some of the longer-term spending needs that countries are facing. And moreover, some of these spendings are expected to increase further. And on top of it, we have a new private demand for capital from the private sector as well. So it seems to me that all these structural transformations the economies are going through, requiring a very high capital-intensive investment, which means that governments will increasingly be competing with private investment opportunities for global savings. That means that actually the market will probably much more likely to be even more sensitive to the changes in the fiscal fundamentals, but also that it raises an important question for the future and the role of central banks, which is that whether the central bank will face growing pressures to participate further in the government bond markets, perhaps even in the primary markets, because the market is really constrained in terms of the demand for government bonds. So in that sense, perhaps I would say that the report is setting a base for a new macro fiscal financial nexus rather than just the latter two. The next slide, please. In these type of reports, I often like the boxes because they tend to be one of the most analytical pieces of these type of reports. Not that the rest is not interesting, but I find it a very elegant way of showing in box B, where the whole financial fiscal nexus is explained and analytically exhibited. So here there's one issue though that I would like to bring to your attention. So in this analysis, where the report highlights the fiscal financial nexus, and especially on the impact of financial intermediation on fiscal space, the growth is treated as exogenous. This has implications because ultimately the financial tightening shock will directly impact the fiscal space. If you go to the next slide, I will show you some of the implications for it. So this is from the report. As you see here, we have the fiscal space, the fiscal reaction with the red line, and we have the blue curve, which shows that, which indicates that, when the fiscal space for the government is the interaction between the blue line, which is the sovereign borrowing curve, with the fiscal reaction function. And now, if there is more non-bank financial intermediaries in the market, this blue line shifts up to become the yellow one, and therefore the interaction points with the red line becomes much smaller, tightening the fiscal space. However, now, can you go to the next slide, please? if you add on top of this that actually even the financial intermediation can bring down growth, what we are thinking of with the financial intermediation shock is not from switching to blue to yellow, but actually yellow to purple, which means that now the fiscal space is already exhausted after the shock. Now, the report somehow goes into the conclusion that the fiscal consolidation or fiscal reaction will be needed in this type of the shock. However, fiscal reaction will also be contractionary. So if we go to the next slide, please. You see that with the fiscal contraction, if we think of endogenous growth responses, the fiscal reaction line will also shift up. But then, because it's endogenous, this may further bring down the financial tightening, almost pushing the economy into some sort of vicious cycle with fiscal consolidation and tightening of the financial system. I'm saying this not to say that the fiscal consolidation is not necessary for many of the advanced economies. However, we should be a bit more careful on the root cause of the problem, which seems to be more of the risky borrowing from non-bank financial institutions, rather than necessarily in the context of this point on fiscal consolidation. Can we go to the next slide, please? My second comment is on the heterogeneity across countries, which I found that very little discussion is there. Most of the diagnosis, if I may, is on advanced economies, and I agree that fiscal financial nexus is a common issue between economies. However, the transmission mechanism may differ fundamentally across advanced economies and emerging markets. In reserve currency advanced economies, sovereign stress increasingly propagates through non-bank financial institutions, repo markets, and sovereign market liquidity. In many emerging markets, however, the dominant transmission channel remains exchange rates, capital flows, and foreign currency balance sheets. So therefore, the same shock creates a very fundamentally very different debt dynamics, especially for emerging markets affecting the stock of debt as opposed to advanced economies. Next slide, please. This brings me a second point on related point on monetary policy. In terms of policy implication, I find that the implications mostly focused in the reports on monetary policy transmission and backstopping. But I think the real issue here is more about how high debt levels in the context of very high non-bank financial institutions also pushes a much closer interaction between monetary policy and fiscal policy. How exactly should a central bank sequence its tools when it simultaneously needs to hike the policy rate to fight inflation, but at the same time, it will need to buy bonds to prevent fiscal-driven non-bank financial institutions collapse. So then there's the issue of the central bank balance sheets that the report is a bit silent on as a result of all these processes. When central bank hike rates in a high debt world, they may take losses on the massive sovereign bond portfolio. So this is, I think, an important point. For emerging markets, they even face a different problem because there, the policy tightening, they may actually bring further worsening of fiscal sustainability if it triggers some sort of a self-fulfilling expectations on what the government's main intentions are. So I would imagine that the policy implications could be a bit more elaborated separately for emerging markets and advanced economies. And here, as I mentioned before, for emerging markets, the main source of vulnerability could be the exchange rate, that the report could go a bit further on this. Next slide, please. So on this, I just wanted to give some insights on our recent work on integrated policy frameworks that doesn't have fiscal policy, but in the context of this discussion, I will introduce that and see what this can offer us. Next slide, please. So here, this is a case where emerging markets face a shock, where you see the exchange rate depreciates and fiscal space tighten in a traditional sense, so with no FXI or capital controls. However, the next slide, please. In fact, if these tools were available to monetary policy, this shock could have been a bit more mitigated with the use of FXI with the blue line. And next slide, please. And actually, almost complete stabilization could occur with the black line. I'm saying this because this implies that for emerging market economies, in this type of fiscal stress environments, in some cases, it may be the case that some other monetary policy tools may be employed to avoid excessively dramatic implications for output, and as well as to stabilize the fiscal policy a bit better. So in that sense, I would expect the report to be a bit more elaborative on what would this imply both for advanced economies and emerging markets. Next slide, please. So I will stop very soon, but just to highlight a couple of things that I think this fiscal financial nexus that the report highlights could be used also for further policy implications. First, as I mentioned before, the cure doesn't seem to match the disease. The report highlights the diagnosis on non-bank financial institutions, what type of risks it may be infusing the system. But focusing a bit too much on the fiscal side of things, I think the main fragility here is coming from the market intermediation and potential dysfunction. So I would suggest to put more emphasis there. And then, of course, in terms of the debt management, in addition to extending maturities, perhaps some of the other discussions broader on how we can build a more resilient investor base or strengthen market absorption could be emphasized. And for central bank backstops, of course, obviously in this context is a very important mechanism. However, in real time, that would require distinguishing when fiscal repricing is happening from market dysfunctioning, which could be a very difficult task to do. And even central banks, when they need to restore market functioning, there should be certain principles on what type of instrument they can choose, what type of pricing and duration exit. The report goes in there, but I think all the pieces are there, but perhaps a bit better narrative could be presented. And of course, in all of this, again, this report, this high debt levels with more risky financial intermediation, I do think that it brings new considerations for monetary policy independence, both to absorb further increase in government bonds, as well as potential pressures from the government, and as well as the backstopping of the market. So I think that there's more thinking on this could also be helpful. And I will conclude. Next slide. Just a few thoughts on this. Again, it's an excellent report, and I thank BIS for getting into this important issue. Thank you so much.
Thanks so much to all the presenters for this very, very enlightening presentation. So first, Gaston may want to react.
Yes. No, I wanted to thank Filiz really for this excellent and thoughtful discussion. Really, really very, very insightful. I mean, on the endogeneity of growth, a very good point. In a richer model, one would have to include that, and then things become more complicated. And it's what you highlighted is very. I mean, conceptually for sure it's right. The question is then, how do you calibrate these things? But it's, I think, something that we should think of. On AEs versus EMs, that was a bit of a theme in your comments. In a way, what we highlight in this chapter has, in a different way, been known already for long for emerging market economies, in the sense that you can reach, your fiscal limits much more quickly and abruptly than if you just look at that sustainability analysis dynamics, because you are subject to the ups and downs in global financial conditions and so forth. and then, you know, on top of that, often the exchange rate mismatch is the things that you mentioned, rightly so. So in a way, we say it a bit in the report, you know, in a way, we kind of know these dynamics. They're different, of course, they're different from the ones that we now see in advanced economies, but fundamentally the type of role of financial intermediaries and foreign financing and so forth in accelerating and very sharply in some instances your fiscal stress is known. So that's why most of the discussion is indeed on the growth of hedge funds and that kind of ecosystem in advanced economies. I would, however, say that we don't only stress fiscal consolidation. We do argue that these policies tend to move in tandem, that we need to strengthen regulation to limit that excess leverage and those fragilities that we have there, that we need to reform, still have them, but reform central bank backstops, that we need to boost growth through structural reform, and that fiscal consolidation is important to contain that, you know, to improve the fiscal path, but doing so in a way that doesn't adversely or doesn't affect growth in a too adverse manner, as was your point in discussing the box. So thank you very much.
Thank you, Gaston. So I could try to summarize and link the various questions. There are many of them, but I guess that many of our speakers have probably looked through them during the presentation. So I would like to give instead the chance to each of you to react to or to pick any specific aspects you might be interested, and then we conclude because we just have a couple of minutes. Maybe starting from the discussants. I don't know, Filiz, is there anything you want to add at this point before we conclude?
Sorry, I think that is really the first and the second parts in some ways is linking really well, you know, the highlighting, I think trying to think a bit more on how governments are going to deal with the challenges, both in terms of the AI related uncertainties, but perhaps some string of hope there. And at the same time, the spending needs and fiscal, fiscal pressures related to that in the context of this type of financing. I think it's it's really excellent point, and I really applaud BIS for getting that at the heart of this discussion with this report. Thank you.
Thank you. Era, any comment?
No, just to say that I naturally speaking, I should have reviewed what Gaston was talking about, because that's exactly some of the topics, the themes that he covered are very close to my heart. Some of the ones that we actually discussed at length in the fiscal monitor. And just to say, it doesn't have to be consolidation. You can spend smarter. We have shown that it is possible. But I wanted to go back to the first topic. And I think there's a lot of challenges that we will need to be thinking about. And I think this kind of an approach of using scenarios to think about potential outcomes and the policy line that countries will have to think about. I mean, the effect on R*, just something that was touched upon in the short term versus the medium term. People were raising the question about, would growth be very lopsided? So is this fundamentally an AI and China? Is AI fundamentally a US and China story? What happens elsewhere? Is it really Europe or emerging markets where the labor market displacement is going to be more significant, but all the rents accrue elsewhere? What happens to tax bases and how broad-based the productivity gains are? These are all questions that are fundamentally up in the air. And how, as the AI build-out proceeds, what happens to actually spillovers to the rest of the world through real financial and other channels still remains an open-ended question. So, but I wanted to thank both Frank and Gaston for an excellent report.
Thank you. So Frank and Gaston, 1 minute each to conclude.
Yeah, I mean, just building on what Era just said, I think these are the important issues. Maybe two things to add. First, on policy responses. I mean, the uncertainty is so large, and that was one of the points we wanted to make with the different R-star scenarios, that policy should try to be robust to that uncertainty and not bet on one or the other scenarios. And it does mean you have to do the scenarios, you have to look at all the possible, but also very much monitor what's going on in the economy. And our discussion on demand versus supply is exactly the type of discussions one needs to do, but and see what happens in the data. So robustness, I think, will be very important. And the second that I also would highlight is the implications for divergences across countries and regions. I mean, one can think of a situation where global R-star does increase, but if the benefits in terms of global growth are diverse, then that can have very divergent implications for R-G and for fiscal sustainability. So that's the two are very much also, and of course also for capital flows and exchange rates. And sort of working out the details of how different countries, given their situations, will be affected, I think will be key.
Gaston?
No, nothing to add, but just wanted to thank both Era and Filiz very, very much, and also the organizers and you, Fiorella.
So then I maybe let Ernest close this useful webinar. Thanks to all the speakers from my side.
Thank you, Fiorella. This concludes today's SUERF-Baffi Bocconi lecture on navigating economic shifts, the AI boom, public debt, and financial market risks, lessons from the 2026 BIS Annual Economic Report. A big thank you to our speakers, Frank, Era, Gaston, and Filiz, for your super interesting presentations and for being prepared also to discuss with us. To Fiorella for setting this up, great initiative, thank you so much. And to all of you for your active interest and for joining us today. Bye-bye and take care.
Bye-bye. Thank
Bye.
you.
Bye.